following is a paid program. The opinions expressed are not necessarily those of WNBU and Interbanks Media. Welcome to All Things Money with David Blain, a thoughtful and revealing discussion of actionable ideas and effective strategies to help you through the complex world of investing, taxes, and real estate. Now, with All Things Money, here's David Blain.
Hello and welcome to All Things Money. I'm your host, David Blain. Thank you for joining us today on 94.1 FM WNBU as well as cable TV 10 in New Bern, North Carolina. We also welcome those viewers and listeners streaming from the web, from our website, www.dlblain.com. We've got a great show lined up for you here today, and we appreciate all the viewers and listeners that contact us with ideas and questions. We love getting input from everyone. We want to talk about things that are relevant to you, not what I want to hear, but what you want to hear about, things that you're interested in, questions you may have. So feel free to give us a call. Our phone number is 252-633-0107. Our email here at the show is allthingsmoney@dlblain.com. And of course, you can go to our website, www.dlblain.com, and click the Contact Us button and give us your thoughts. I wanted to start off with a quote today from one of my favorite people, Jeremy Grantham. Jeremy is he's been around the investment industry for a number of years, 40, 50 years, and he's one of the great thinkers. He does get kind of a little bit far out there sometimes with some of his ideas on some things, but for investing, he's been doing it a long time, and he has a great perspective on historical machinations of the market and valuations and things like that. And this quote this week is a little bit long, but bear with me, there's a great point behind it. So Jeremy says, 90% of what passes for brilliance or incompetence in investing is the ebb and flow of investment style, such as growth, value, foreign, domestic, etc. Since opportunities by style regress, past performance tends to be negatively correlated with future relative performance. Therefore, managers are often harder to pick than stocks. Clients have to choose between fact, past performance, and then conflicting marketing claims of various managers. As sensible businessmen, clients usually feel they have to go with the past facts. They therefore rotate into previously strong styles, which regress to the mean, dooming most active clients to failure. This is a great quote, and let me break it down and kind of help you understand why I bring this up. And as I've said many times on the show, there are different investing styles. You know, there are value managers, there are growth managers, there are more technically oriented managers, there are more fundamentally oriented managers. There are U.S. based, there's foreign based, there's all different types of style. And given enough time, as long as the style has some sort of basis, you know, I don't think, phases of the moon is a good way to pick your investments, but if it has some sort of, reasonable basis in reality, then the styles go in and out of favor. But what happens is people look at, for example, foreign investing. You know, after the initial run-up, after the Great Recession, maybe in 2009, 2010, 2011, been awful for foreign investing. So a manager that invests in Europe, it looks pretty bad. It looks like he doesn't know what he's doing. Number two, someone that invests in a diversified portfolio that's had any exposure to Europe or even emerging markets last year has had a very rough time. And it's not that the manager is incompetent or someone that has, picked U.S. Large technology growth, which is Apple, looks brilliant the past couple of years. But the reality is that over time, investing, whether it's a stock or a bond or anything like that, cannot return more than what is reasonable. What happens is if a particular investment is returning more than the risk involved, is more money floods into that particular asset class, and so it brings the prices down. As people flee an asset class or brings the returns down. So as the U.S. becomes sort of the hot place to invest, more and more money floods into it and drives the price up for a while, but eventually the prices revert to some sort of long-term average. Now, what that long-term average is, nobody really knows. You know, is it 6%? Is it 8%? Is it 10%? We don't know, but the point is that time and time again, prices of investments tend to overshoot or undershoot their fair value. And so what happens is the individual investors simply become impatient. And you'll see that a different style, for example, we tend to look at both valuations as well as relative strength and staying in harmony with what's going on in the market. Well, that type of investing, diversified across many asset classes, sometimes does very poorly compared to the market, you know, the S&P 500. Other times it does very well, and these cycles tend to ebb and flow. But what typically happens, and it's not that the manager is doing anything wrong. If you signed up for a value manager and he's underperforming the S&P 500 for the past 2 or 3 years, it doesn't mean he's done anything wrong. In fact, value as a class has been underperforming. There are times that active management does better than indexing. There's times that indexing does better than active management. But the reality is what happens is that clients and investors become easily discouraged and convinced somehow that, you know, value investing is broken and you can never make any money in that. And you see that to some extent today in stocks, is that the market is broken, you can never make any money of that. And so they change managers or they change styles. They say, oh, value investing isn't work anymore, I'm going to become a growth investor. Or fundamental investing doesn't work any longer, I'm going to become a technical investor. Or the chartist says, oh, well, this charting isn't working anymore, I'm going to become a fundamental investor. But what typically happens is that they do it at exactly the wrong time, that these cycles run in good 3 to 5 year cycles of under and underperformance. And we typically see that, you know, clients, you know, some people can't put up with a month worth of, you know, different performance, but some people it's a year, some people it's 2 years, but generally these cycles run 3 to 5 years, and a lot of people have a hard time staying with a particular style throughout that time. So anyway, the point is, if you have a fundamentally sound investment style or manager that uses time-tested principles and their style goes out of favor, it does not necessarily mean that you should move on to the next thing, because time and time again we've seen that investors typically do a very poor job of making these decisions. Well, it's time for our first break. So for All Things Money, I'm your host, David Blain.